Today I'm going to talk to you about the time value of money. I'm going to do a brief video on the time value of money, and in future videos I'll go more in depth. But for now, I'm just going to give a brief, broad description. Okay, so what is the time value of money? To think about the time value of money, let's give an example. If you were given the option to receive $1 today or $1 a year from now, which would you choose? You probably choose the dollar today. And the reason why, there's two reasons for that. The first reason is because people in general want to consume sooner rather than later. Would you rather live in a house now or later? You'd probably rather live now, which is why people are willing to take out a mortgage and pay extra on interest. The second reason is because if you were given the dollar today, you could do something with that dollar. You could invest it or start a business with it, and you could earn interest on that dollar. So let's say we lived in a world where there was only one type of investment available. Let's say a Canada Savings Bond, so we know there's no risk, and it's a 5% interest. So if you were given $1, or let's say $100 today, you would know that a year from now it would be worth $105. So now, if someone offered you $100 today or $105 a year from now, you'd be indifferent between the two. So in the real world, of course, it's much more complicated than this. There's many types of investment. There's bonds, there's derivatives, there's stocks, there's real estate, there's businesses, there's venture capital, there's all these things. But in our simplified example, there's only the Canada Savings Bond. So let's say someone said, if I'm going to give you $105 a year from now, what amount would be it equal to now? And the answer would be $100, because you can invest that 100 and get 105. So the time value of money works both ways. You can bring the time value of money forward, or you can bring it backwards. So how does this relate to stocks? Well, really it relates to every type of asset. But in terms of stocks, what you're doing is that the company that you're investing in has a cash flow. It generates a certain amount of income. Now, unlike a Canada Savings Bond, which is guaranteed to give you a certain cash flow, that $5, stocks are a bit more volatile, their cash flows, like any business is. So what you're basically doing is, when you're looking at a stock, is you're looking at the cash flows, and you're seeing, based on the equity in the company, or the $100 you have, what type of return will I get? What is the likely return that I will get? So let's say it's a company, and for the last 100 years, it's always got a 10% return, right? And in order to buy it into the equity of the company, it's worth $100, right? So every year gets 10% return, and the company is priced so that if you put in 100, you'll get 110. Then right now you're indifferent between the company a year from now or the company then. It's the same thing. But what if for some reason the market mispriced the company, either too high or too low, based on the rate you should be receiving? That's where the time value of money comes in to investing. And obviously it becomes much more complicated than that, and that's why you can only really have a range of values of what the rate the company should be returning to you. And there's things like the risk of going bankrupt, there's things like competitors, there's the strength of the balance sheet, there's how consistent are the earnings. But generally, if you look at a company and you understand the industry, you understand the company, you understand kind of how the competitors work, all these things, you can come up with a range that kind of makes sense. And if the price of the company is far below the range it should be in, then you know you have a quote-unquote undervalued stock. And this is basically what people like Buffett and value investors are doing when they look at companies. So that's a basic idea of the time value of money. And I know for me personally, I had read Buffett and I read all these guys, and when I first read them, they kept saying undervalue this, undervalue that. There's all these things about bonds. I didn't really understand it until after I took my first finance course and I understood the time value of money. And that's what really allowed me to understand all this, not all, but the majority of the stuff that I had read about investing before I went to university. Anyways, just wanted to do a short video on that topic, and it's pretty common knowledge. I mean, Most people in finance or accounting or business school will know about the time value of money, but a lot of people don't, and it's super important to understand it so you can weigh up different investment decisions on what you're going to make. If you have to understand what amount you'd be indifferent to receiving in the future and in the past. So that's it for today. Future videos will do some numerical examples, things like that, and it'll become a lot more clear once you actually put it in numbers and put it in more defined terms. Anyways, that's it for today. Thanks.